In today's video, I'm going to introduce you to what's probably my favorite dividend growth investment strategy. This strategy is going to generate a minimum of 12% annual returns if you execute it correctly using the steps that I'm going to share with you. So stick around because I think today's video is going to be really special. Before we get into the details of the strategy, let me walk you through why this strategy is so amazing. Let's imagine that you buy shares of a stock with a 4.5% dividend yield, and this company raises its dividend by 10% each year. After 10 years, this stock is no longer paying you 4.5%, it's now paying you 10.6%. After 12 and a half years, the company has paid you back your entire cost basis. Those shares that you purchased 12 years ago are basically free now. Your cost basis is negative, and every dividend that you receive from here on out is 100% pure profit. Fast forward to year 15. Now these shares are paying you 17% return every year. In year 18, you'll have collected so many dividends that the company has now paid you back double your original investment. And by year 20, those shares will be paying out an astounding 27% average annual return every single year. By the time you reach year 20, those dividends will have paid you back 250% of your original investment. Keep in mind that this 250% does not include any capital gains. Even if the stock traded flat for 20 years, you still received a 250% return on this investment. Once you understand the math behind this system, a light bulb should immediately go off in your head as to the wealth creation possibilities here. So what is this magical strategy? Well, the strategy that I'm going to teach you today is called the 10-11-12 system. It was created by Mark Lichtenfeld. Lichtenfeld is the chief investment strategist at the Oxford Investment Club. His book, Get Rich with Dividends, was an instant bestseller when it was released in 2016. The 10-11-12 system is a dividend growth strategy that places very specific rules around investing. If you implement the program correctly, then you can expect your portfolio to earn 12% annual returns and an 11% annual dividend yield after 10 years. After the 10-year mark, the wealth will really begin to compound at a fast pace. The difficulty with this strategy is having the discipline to stick it out and follow the rules to get to that 10-year mark. But if you can do it, you will be handsomely rewarded. In order to effectively use this strategy, you need to make sure that you're traveling in the correct universe of stocks. You don't want to be trolling around the growth stock solar system to find the planets that we're looking for. For this to work effectively, you need to start by finding companies who are paying dividends and who are perpetually raising their dividends each and every year. Luckily, this idea of exponential dividend growth has been around for a very long time, so there are some indexes that we can refer to and you'll get to know really well. The first index, and probably most popular index, is the Dividend Aristocrats. In order to get your company on this distinguished list, you must meet the following criteria. Number 1, you must already be listed on the S&P 500 index. Number 2, you must have increased your dividend every year for the last 25 years in a row. Number 3, you must have a market cap of at least $3 billion. And number 4, you must have a daily average trading volume of 5 billion for at least 6 consecutive months. Just below the Dividend Aristocrats, there are some other indexes that we can refer to. I won't get into all the details, but I will provide links in the video's description. The first is the Dividend Champions, then the Dividend Achievers, then the Dividend Contenders, and finally the Dividend Challengers. All of these indexes can act as a great starting point to find companies who grow their dividend consistently. Let's talk about the rules to the 10, 11, 12 system. There are 3 rules that a company has to meet, and then there's a 4th rule you may want to look at. Rule number 1 is the dividend yield must be 4.7% or higher. If you're having a hard time finding stocks with a 4.7% yield, you can go as low as 4%, but that's the floor. Don't go below 4%. Number 2, the payout ratio must be less than 75%. Rule number 3, the annual dividend growth rate needs to be over 10%. And the 4th optional rule is you should prefer stocks where the 5-10 ratio is greater than 1.0. The first step in our dividend growth hunting safari is to sort the 2021 Dividend Aristocrats by annual dividend yield, highest to lowest. Remember that our universe of opportunities is fairly small. If we limit ourselves to stocks that pay out 4.7%, we have just 7 options to pick from. Exxon, AT&T, Chevron, FedREIT, People's United, Realty Income Corp, and AbbVie. But let's go ahead and use AbbVie here because I personally own some AbbVie shares, and AbbVie is a company that I've spent some time researching. We can see that AbbVie is paying $5.20 per year per share, which gives us an annual dividend yield of 4.74%, which is just over our required 4.7% threshold. Let's go to Seeking Alpha and review the dividend scorecard for AbbVie. We need to make sure that the payout ratio is less than 75%, which it is. And next, we need to make sure that the dividend growth rate is over 10% annually. For whatever reason, there's no value yet for the 10-year rate, but we can see that the 1, 3, and 5-year periods, the growth rate is above 10%, which is perfect. The last thing that we want to do is make sure that the company itself is successful and the dividend isn't a fluke or a warning sign or isn't at risk. So we want to check the financials to ensure that the company has rising sales and earnings and positive cash flow. The financial statements on Seeking Alpha are gimped by a paywall, so you can't see the full picture, but you can do a quick glance to be sure that the recent numbers look good. Now that you've found a dividend aristocrat that you like, that you're going to utilize with this strategy, then once a year you're going to want to check up on all your holdings and make sure that they haven't been kicked off the Dividend Aristocrats Index, and you want to make sure that they still meet all the required criteria. If any of these companies no longer meet the criteria, then exit the positions and move into whatever new positions that you can find that do meet the requirements. So that's the 10, 11, 12 system. It's a really powerful system and it can build a whole lot of wealth for you. Here are some of my closing thoughts. This system is really best suited for people who prefer to make one large stock purchase each year. If you do this, then each year you can investigate the best opportunities, make your purchases, and then lock in your cost basis and your dividend yield. This strategy is not really super great for dollar cost averaging because the dividend yield that you lock in when you buy shares is constantly changing, since the yield is dictated by the price of the underlying shares, and that can be a real hassle to manage. As an overall strategy, though, I think this one is really fantastic. You just need to remind yourself that the companies that you're holding in this portfolio are for the dividends, not for the capital gains. If you're the type of person who's constantly checking your brokerage and you get high blood pressure when you see red, then this strategy is probably not for you. It takes time and you're rewarded for that time. But if you let them, the dividends and the persistence of time will make you very, very wealthy.